Welcome back, everyone. If you're a focused learner looking to literally master the mechanics of building a successful business from the ground up, well, you're in exactly the right place. Today, we're unpacking a comprehensive guide on project finance and feasibility to help you construct a rock-solid business blueprint. Whether you're starting a manufacturing plant, opening up a boutique hotel, or launching some massive software startup from your garage, the foundational principles, they're exactly the same. So let's just dive right in. Now, a lot of people think of financial models and detailed project reports, or DPRs as we'll call them, as just, dry math and boring spreadsheets. But actually, a financial model is a really compelling narrative. It's the story of your business, but instead of words, it's told entirely in numbers and logic. Every single cell in that giant spreadsheet represents a real-world decision you're making, a risk you're taking, or a major milestone you've achieved.
And to tell that story effectively, your detailed project report has to answer two massive, totally fundamental questions. First up, does this even make business sense? This is basically the core of your feasibility report. Like, is there actual demand for what you're building out there? Second, will the math actually work out day to day and year to year? This is where your financial model steps in. Because look, it's one thing to have a fantastic idea. It is a completely different thing to ensure you can actually keep the lights on and pay your employees every single month, right?
So here is our roadmap for today's explainer. We're going to look at the business story in numbers, setting up the foundation, structuring your funding, tracking the math, and finally, proving it all to lenders.
Starting off with part 1, the business story in numbers.
Which brings us right into part 2, setting up the foundation.
Okay, before we can even begin to dream about future profit margins and making millions, we have to define exactly what is needed to physically start and then actively run the operation. And that brings us to two categories you absolutely must understand: CapEx and OpEx. CapEx, or capital expenditure, refers to your one-time initial setup costs, things like buying land, buildings, or heavy machinery. On the flip side, we have OpEx, operational expenditure. These are your ongoing, day-to-day running costs. Think raw materials, salaries, rent, electricity. It's kind of like CapEx is buying that fancy commercial espresso machine, right? And OpEx is buying the coffee beans and the milk every single week. Beginners mix these up all the time, but keeping your one-time foundation costs totally separate from your ongoing day-to-day expenses is absolutely crucial.
All right, let's move on to part 3, structuring your funding.
So now that we know what we need to buy to set up the foundation, how do we actually pay for it? Well, funding basically comes down to two sides of the same coin. First, we have your means of finance. The core question here is simply, where are we getting the money? The answer? Your sources of capital, which generally boil down to equity, which is cash from the owners or investors, and debt, which usually means bank loans. Then, the second side is the application of finance. The core question here is, where is every single dollar going? This is your highly itemized allocation of those funds. How much goes to buying the land? How much to the equipment? How much is kept back as reserve cash? Basically, you're tracking the sourcing, and then you're strictly tracking the spending.
And so the crucial point here is this golden rule. Total means of finance must equal total application of finance. Period. It's non-negotiable. Every single dollar you raise from an investor or borrow from a bank has to be strictly accounted for in your spending plan. You can't have phantom money floating around, and you absolutely cannot have unexplained expenses.
Next up, part 4, tracking the math.
Moving into the operational phase of your business blueprint, we have to track the day-to-day numbers over time to ensure the business actually stays healthy. And to track that health, we rely on 3 core financial statements. You can think of these as the vital signs of your business. We've got the profit and loss statement, the cash flow statement, and the balance sheet. Let's break down exactly what each of these does.
First, let's break down the huge difference between the P&L and the cash flow statement. The P&L tracks profit on paper. It's a pretty simple formula. Revenue minus expenses equals profit over a specific period, like a year. But guys, here is a massive warning for you. A business can look highly profitable on paper in the P&L, but still go absolutely bankrupt. Sounds crazy, right? But why? Well, because of what the cash flow statement measures, actual hard cash in the bank. If you made $1 million in sales, your P&L looks amazing. But if your clients haven't actually paid their invoices yet, you have no real cash to pay your employees. That is exactly why tracking the actual movement of cash in and out of your bank account through the cash flow statement is literally vital for survival.
Now, the third vital sign is the balance sheet. Unlike the P&L or cash flow statement that track activity over a period of time, the balance sheet is a literal snapshot at one specific moment. It shows exactly what the business owns, which we call its assets, versus what it owes, its liabilities. And then what's left over is the owner value, or equity. So it's basically a freeze frame of your company's exact financial standing on any given day.
Now, as you track all this math, you're definitely going to encounter a concept called depreciation. Let's say you buy a delivery truck for $50,000. If you recorded that entire $50,000 expense all at once in year one, your profit for that year would just look terrible, right? But that truck is going to be used for 5 years. So depreciation allows you to spread the cost of that long-term asset over its useful lifespan. Instead of taking a massive hit all at once, you record a $10,000 expense each year for 5 years. It's a really smart way to protect your early financial statements from looking artificially disastrous.
Okay, so all of this math eventually builds up into your key metrics, starting with IRR, or internal rate of return. This is the annual percentage return generated by the project. When investors look at your numbers, this is the ultimate measure of how attractive the project is to them. Quite simply, the higher your IRR, the more attractive your business blueprint is to anyone who might be thinking about giving you equity.
But what about the banks? Well, they actually don't care about IRR nearly as much as they care about DSCR, the debt service coverage ratio. This is arguably the most important metric for securing debt. It measures your exact ability to pay back your bank loans. The formula takes your cash available for debt service and divides it by your principal plus interest payments. Basically, it shows if you generate enough real cash to cover your loan obligations. If this number is bad, the bank simply stops listening.
Now, there's a very specific number you need to burn into your memory, 1.35. If your DSCR is exactly 1.0, that means you're generating just enough cash to cover your loan, you are barely breaking even on the debt. Lenders absolutely hate that. Banks want to see a target ratio greater than 1.35. They want clear, undeniable evidence that you have a 35% cash buffer sitting there above your loan obligations just to account for those unexpected rainy days.
Which leads us perfectly into our final section, Part 5, Proving It to Lenders.
So, you've gathered your CapEx and OpEx, you've balanced your means and applications, and you've built out your financial statements. Now, to actually get that financing approved, you need what's called a bankable detailed project report, and it absolutely must include 4 vital things. First up, validated market research. We need real proof of demand here, not just unbacked assumptions. Second, sensitivity analysis. You really have to stress test your model. Like, what happens if your raw material costs suddenly spike by 15%? Does the whole business just collapse? Third, clear risk mitigation strategies, which are basically your operational backup plans. And finally, that healthy DSCR we just talked about. Proving those loan obligations will be easily met across all of your projected years.
So what does this all mean? We've gone from the raw foundation all the way to a completely bankable blueprint. Remember, building these models isn't just mindless data entry. It's the actual narrative of your business's survival and success. So I'll leave you with this final provocative thought as you look toward building your own models. When the lenders sit down, grab their coffee, and open up your detailed project report, what story will your numbers tell? Thanks so much for joining me on this explainer, and keep learning.